Hi everyone, welcome to the Digital Fifth Fintech Show. Today we have with us Shiv, who's the joint managing director and co-founder of DMI Finance. DMI Finance is a unique platform or company, which is basically instead of doing a direct typical B2C business, they work in a B2B side. They have a lot of partners in the ecosystem, almost 40 plus partners with whom they work, and they actually work with them for lending to their customers. So it's a unique business model. And obviously, as an NBFC, not too many guys have that kind of business model and platforms. So they're very unique. And I'm very happy to have Shiv today on board. Thanks, Shiv, for joining us. And it will be useful for us to understand a lot about what DMI does, more from an inclusion perspective and generic ecosystem perspective. So thanks, Shiv, again for joining us.
Thanks for having me here, Samir. This is very exciting. And obviously, given that we are all sitting at home, there is more than ample time for me to be doing things like this. Just to introduce DMI, because I'm sure most of your audience probably has no idea who we are. We are
when I left my bank, I did not know anything about you. And
right.
I think with time, I realized that wherever I used to meet anyone, and they would say that first port of call is always DMI, and you guys are there for almost all fintech startups, right? So brilliant.
So we are about a 12-year-old financial services platform with a focus on credit and lending. Mm-hmm. We have a bunch of different verticals. Consumer finance is one of our very strong focus areas. Mm-hmm. And within consumer finance, we focus only on digital lending. Mm-hmm. So digital origination, digital underwriting, digital fulfillment, and mm-hmm. then collections to the extent that's possible digitally. We have a housing finance vertical, which is catering to the affordable housing segment. We have a corporate lending vertical that includes real estate lending. Mm-hmm. And we have an asset management platform, which manages a family of AIF-driven funds.
Okay.
So broadly speaking, that's the areas that we play in. We have a team of about 600 people, a little more than 600 across the country. Mm-hmm. In each of these areas. The bulk of that is focused in our housing business, because our housing business is a branch-led, middle market affordable housing segment. Mm-hmm. Our digital lending business runs entirely out of our head office in Delhi.
Okay.
And it is very much an API-driven. We only talk to partners who can talk to us directly via API. Mm-hmm. Mm-hmm. Our consumer and SME business is what we would think of as a B2B2C business, right? Mm-hmm. So we don't have a direct customer-facing presence mm-hmm. on the marketing side.
Okay.
We source transactions through a large number of intermediaries, and these intermediaries are basically, for us, they're demand aggregators, which mm-hmm. could be fintech startups, they could be OEMs, they could be large corporates. Mm-hmm. They could be e-commerce platforms. And then we do the credit piece. So we work on the underwriting, we work on the fulfillment, the data analysis. We are heavily reliant on our partners for the customer front end, and we manage the customer back end. Mm-hmm. Our goal is to provide a credit decision for all of our cases mm-hmm. in under 60 seconds.
Wow. Okay.
Today we are doing that for, I would say, about 93% of our population.
Okay.
So there is a little less than 10% of our population where the credit decisioning goes beyond that. Can extend into a matter of hours, but not into days.
Okay. And maybe a specific question here. Most of the NBFCs, maybe the so-called classical NBFC structure, you've seen them, their tech being very weak, and primarily Excel-based lending is what happens there. How did you manage to create such a framework which is all API enabled and so much of AI ML getting incorporated? So how did you go about doing it?
Well, I mean, a lot of it was very conscious. So our digital lending business started in late 2015, early 2016. And the approach to this business really came out of why this business existed in the first place. Mm-hmm. So if you look at the existing market leaders and the existing behemoths in the space, whether it's the banks or whether it's someone like Bajaj Finance or Capital First or whoever you want to think about, they already have an existing uh, physical process, right? They have solved for how to most efficiently originate a loan at the lowest cost.
Correct.
Using a human-based process, right? So they have tens, if not hundreds of thousands of locations around the country.
Correct.
They have their feet on the street, originating loans for them. And so it really doesn't make sense from our perspective as a new lender to try to compete on those terms. Right? So replicating that kind of an infrastructure would take us years and be extremely expensive. So when we entered the consumer lending space, the motivation behind it was that India is rapidly digitalizing. India's stack is rapidly gaining greater and greater, not just awareness, but adoption. And access to information is becoming easier and easier digitally. And we anyway have a young, vibrant, and very digitally savvy population, especially the urban and the semi-urban population. So it was just, if you're sitting in 2016 and you're looking to build a consumer finance business, you're not going to build a brick and mortar business, right? So we had the luxury of not having any legacy business at all to, in many ways, to mess up the way we are looking at the world, right? So we had the luxury of saying, okay, if we are starting in 2016 and we have no existing consumer business, how would we do it? And the only answer we could think of was that it would have to be API driven.
Okay, so this is one tech side, but cultural issue is also there, right? Everybody wants to own the front end and the whole process and say, this is my piece. Creating this kind of partnership structure is not easiest of the things. And I've seen enough times warring categories come up saying, business will say, I don't want to work on it with this partner. Partner will say, there's one fraud. Why are you removing me? So how do you manage this collaboration between you and your partners and they can trust you, right?
So I trust, it takes time to build. And in many ways, you are forced into a position of trust initially when it's a business imperative, right? So for us, the ecosystem developed in a way that the fintech startups or the large, the e-commerce platforms, et cetera, they needed a back-end lender, right? So they need a lender of record, unlike in many other countries where you can lend without being regulated. In India, you cannot, right? In India, you have to be a regulated lender, whether you're a bank or an NBFC, in order to make loans, right? So tech companies, the fintech startups, needed a lending partner. Now, that lending partner could have been a lot of people. They could have been the existing banks, existing NBFCs. But by and large, as I said, those entities suffered to some extent from what you just described, right? They want to own the ecosystem. They want to own the customer journey from the beginning to the end. They want to own the customer. We didn't have a legacy business, right? So in many ways, the easiest thing for us to do was to partner, because owning the customer from beginning to end is extremely expensive, is extremely time intensive, right? So to scale that business takes a much longer time. And so just like the fintech startups needed a lender to partner with, we as a new lender in the space needed the originators to partner with. So you're forced into a situation where either you trust your partners and make it work, or you don't have a business, right? For both of us, that was the situation. So we were forced into a position of trust.
It's a great answer, because maybe you did not have a competing channel. So if you had a branch or you had an alternate channel there, I think they would have fought against this. Now you had a clean slate and you could build it, right? Which is
Exactly. And as I said, not having a competing channel was a strategic decision. because I don't think you can reasonably start today and build a business in the same image as Bajaj Finance and win that game.
Correct.
Right.
Absolutely. So coming to the size, I think we were talking about partnership, maybe just for audience perspective, how big is your partner ecosystem size?
So we currently have a little over 40 different partners across the fintech and OEM and e-commerce, basically the digital India ecosystem. And we are always looking to add more.
Okay.
So,
and what does it take to partner with you? What kind of sort of characteristics, size, and activity you typically focus on?
I think okay. So it doesn't take much to partner with us, to be honest. What we are looking for is digital capability so that you can talk to us in purely API terms, right? So we cannot partner with somebody who wants to send us information over the phone or over email or even in Excel files, right? We need somebody who can interact with us API based, where they can send us information via API, they can receive information from us via API, and that's how it is. So that's really all it takes. Now, when we started, we literally would partner with anybody who could fill those parameters. Today, we've come to the realization that the very small early stage partners take just as much effort as somebody a little more established. So we have become maybe a little pickier than we used to be, but still we are fairly inclusive.
Okay, fantastic. Now, in the current context of COVID-19, what kind of changes in customer behavior do you see? One in short-term basis, now that we have a moratorium kind of challenge, and on long-term basis, because some of them may not have a right in earning capabilities till maybe things come back to normal. So what kind of sort of behavioral change do you see in the customer side?
I think the behavioral changes are going to be, in many ways profound. And in many ways, it's very difficult to tell at this stage how things are going to turn out. So why do I say that? To state the obvious, right? None of us in our lifetimes, in our parents' lifetimes, has seen anything like this, right? Not in 100 years have we had this kind of a situation where people are actually worried about their health. So when you compare the COVID-19 situation to anything in the past, right? Whether you want, so the typical comparisons end up being, oh, let's look at the global financial crisis, right? 10 years ago, we had the global financial crisis. How did governments react? How did central banks react? How did consumers react? Okay, that's one comparison. People talk about, the SARS outbreak, avian bird flu, as another comparison. Okay, none of them really are the same thing. The global financial crisis was a crisis in the banking system.
Correct.
Right. By and large, the average person on the street really didn't know that there was a crisis.
Correct.
Until things had gotten really, really bad, right? So it was not a Main Street crisis that extended out. It was a financial system crisis that then threatened to have knock-on contagious effects on the broader economy, right? Similarly, and that was global. So even though the global financial crisis was global, it had very different roots and very different outcomes. Before that, whether it's SARS or bird flu, those were too contained, right? So you can look at what happened in Hong Kong and Singapore during SARS, but it's not a global event, right? So by and large, the rest of the world, they heard about it, they thought it might get big, but it didn't really happen. Right. So now we're in a situation where both of these are happening. So consumer behavior is going to change dramatically, and certainly in our opinion. So what are going to be the few changes that happen? One is I think purely looking at it as a lender, there is going to be severe contraction in both credit supply and credit demand. Now, both of those are to be expected in some sense. Credit supply but unlike the global financial crisis, which was led by a constriction in credit supply, here, I think you're going to be led by a constriction in credit demand and a constriction in credit supply, which is led by increasing fear among the lending community that the borrowing population is becoming less and less credit worthy, right? The impact on each of these economies is far larger than anything we have ever seen before. Mm-hmm. So the global financial crisis, in the US, for instance, in India, it didn't really register as much, right? I mean, we had a few quarters which seemed shaky and wobbly, but by and large, we skirted it. In the US, the global financial crisis cost the US, $700 to $800 billion. That's kind of the estimate of what the hit to the economy was. COVID-19, on the other hand, is estimated to hit the economy several trillions of dollars. Mm-hmm. So you're talking immediately. You're talking of, a fivefold or more hit to the economy. Unemployment rate in the global financial crisis peaked at roughly 8.5% to 9%. Unemployment rate now is already already probably at around 20%. Correct. Okay, anecdotally, obviously we are not going to know the numbers for a little while, but if you just look at unemployment claims, you are probably sitting somewhere between 15 and 20% unemployment today. Mm-hmm. Okay. The US has not seen these numbers. In India, we don't even have the ability to measure some of these numbers accurately. Correct. Right. So what is unemployment in India? It's really hard to tell. It's really hard to tell. All we know is that we are kind of tracking the different industries and how many people they employ and how hard they're going to get hit and estimate how many people are likely going to get laid off. Okay. Correct. When we look at that, we come to somewhere between 20 and 30% unemployment rate for the non-government, the non-farm, non-government sector, right? What does a 25 to 30% unemployment rate in the non-farm, non-government sector do to consumer behavior? Right? I mean, I suspect it annihilates discretionary spending. Correct. Right? I suspect it puts debt service somewhat low down in terms of priorities. Correct. Right? And so I suspect what it means is that the credit performance over the next few quarters is going to be worse than what anyone is expecting. Okay. Or what anybody had thought would be possible. What does that mean in terms of numbers? I honestly don't know. Would it surprise me if near-term NPA rates went to 20%, 25% in some areas? It would not surprise me, to be honest. Right? Why is that? Why are we? And when I say that, I'm specifically talking about the alternate lenders, the digital lenders, because the digital lending community focuses on the near prime, subprime, correct, and NTC. Right? They are not competing for the super prime borrower. Absolutely. Right? And so the vulnerable borrowers are anyway going to be hardest hit. And so there's going to be a significant change in their in their behavior going forward. From where we are sitting, I think you have to look at the business in two different ways, right? You have to say that this is your business, your book of business before March 2020, right? Everything that you've done up to March 2020 has to go into one bucket. Everything that you do after March 2020 has to go into a different bucket. They're going to have completely different characteristics. The focus on the existing book has got to be on collections.
Absolutely.
Right? I mean, you're not as worried at this point about cross-selling and upselling to that population. You're not worried about really a whole lot there except collections, because that's going to be the thing which moves the needle the most.
Correct.
Right? When NPAs are at 2%, then collections efforts moves the needle by 25 basis points.
Correct.
When NPAs are at 20%, collections efforts can move the needle by 5 to 10%. Right? So for your existing book, I think all lenders will have to focus entirely on collections. Then you have the new business, which is going to come out of this crisis. That new business is going to be very different. For one, I think it's going to be, all lenders are going to focus much more on higher quality origination.
Mm-hmm.
So I suspect that the amount of credit available to NTC, subprime, is going to dry up substantially,
mm-hmm.
at least in the near term. That can have, you can think of it in two ways. You can think of it as there's an opportunity here for somebody who's adventurous and is interested in, exploring that population.
Mm-hmm.
Or you can think of it in terms of lenders are in preservation mode.
Mm-hmm.
And so everybody is going to try to migrate up the credit quality. My personal suspicion is that lenders are going to be in preservation mode, right? There's going to be a grab towards higher quality borrowers. There's not going to be a lot of experimentation going on, in the lower quality and the NTC population.
Okay. And since you are actually on across all the segments, how will you operate? Because you're across every segment, right? You kind of variety you spoke about. So
Mm-hmm.
what's your approach of doing it?
So our approach is going to be, so as I said, we work with a lot of partners, and we give our partners a lot of leeway in terms of what they originate. At least in the near term, we are going to be urging our partners to focus on credit quality. Okay, because when there is a credit contraction, the credit contraction happens across the credit curve, right? So there's credit contraction in the high credit and in the low credit. And for a while, at least, there's going to be good quality loans to be made in high credit, which in better days would not be accessible to alternate lenders.
I agree. I was talking to a bank and or other multiple banks, and all of them have stopped completely on the credit side. Even to their own customers, they are not giving. So I think opportunities will be huge.
Exactly. So I think the banks are going to be faced with multiple challenges. Their number one challenge is going to be that they haven't fully digitalized yet.
Correct.
Right? They were all moving in that direction. Everybody was talking the same talk, but they are far from being there. Right? They are far from having achieved it. Now, certainly in a lockdown scenario, that means that their origination goes to zero. Because nobody's leaving their homes to actually go out and fill out paperwork and get a loan. Even post-lockdown, I think it's going to be very hard for a physical process-driven lender to make a comeback in the way a digital lender is going to be able to.
Agreed.
So as a result, I think the fintech lenders are better positioned in the near term. The near term being, maybe 2 quarters,
mm-hmm.
in which they can grab market share in the higher quality credit origination. And so that's why I think that's where the focus is going to be.
No, I think
you can always come back. You can always come back to the subprime and the NTC, but you should grab the high quality when you can.
Yeah, and this is the right opportunity. I mean, across board, everybody has stopped. So this is good to see a different approach and positive approach there, right? So let's come back to the government policies. There has been support on this side. So what else you would expect? Your analysis of current support available, and what more would you expect?
I think the government support has been anemic at best, grossly inadequate.
Okay.
To be fair, I don't think the government has had a chance yet to announce its support, right? It's taken the government far longer to announce what exactly it plans to do. The RBI has been proactive in terms of announcing its liquidity facilities, but even the RBI response has been highly inadequate, and I'll get into that in a little bit. So there are two aspects to this. One is that there is a global financial crisis playbook, which the RBI is following by and large. Okay, you come in, you flood the system with liquidity, you make sure that the banks have adequate liquidity, more than enough liquidity. They can borrow as much money as they need to. Okay, and you hope that the banks will push this liquidity out into the broader ecosystem. That playbook only goes so far, and we are seeing that already. The banks are basically taking their money and putting it back to the RBI.
Correct.
Okay, so there's a huge amount of money sitting with RBI and reverse repo, and that's not getting pushed out into the broader economy. The RBI is trying to figure out what to do next. So they announced, TLTRO 2.0, where the banks are supposed to, if they borrow that money, they're supposed to lend to NBFCs and HFCs. They announced a mutual fund facility for the banks to tap into. But all of that is also, at least in my opinion, inadequate. Because the problem here is not a problem of liquidity. It's a problem of a lack of trust. The banks don't trust the borrowers, right? So if you're a bank and you are told, okay, I'm going to give you a lot of cheap money. Now you take this money and you go lend it out to the broader economy. If you're a bank credit officer, your response is going to be, listen, I don't know what the future holds. I don't know what this company's business is going to look like. If the borrower is an NBFC, the credit officer is going to say, listen, I have no idea what the NBFC's book is going to look like in 6 months. They might have huge defaults. I'm not going to take that credit decision today because the uncertainty is way too high.
Correct.
So the only way to break this log jam is to take the credit decision away from the banks, right? The banks, if you ask the banks to underwrite, they're going to say, nobody is good credit, so we're not going to lend money. Which means that the underwriting has to be done at the government level, whether it's at the RBI level or whether it's at the Ministry of Finance level. If you look at what the RBI did yesterday, which is it gave, I think it gave about 10,000 crores to the National Housing Bank to provide a direct lending facility for housing finance companies.
Correct.
Right? And there is very little underwriting involved. It just says you have to be of a particular size and your NPAs have to be below a particular level.
Correct.
Okay. If you meet these two relatively simple criteria, you can borrow from the NHB according to some guidelines, right? So that's essentially what needs to be done for the rest of it, whether it's the mutual funds or whether it's the NBFCs or the MFIs. The underwriting decision has to be taken away from the banks. You can either do it through an SPV, where the Ministry of Finance provides the equity, RBI provides the leverage, and that SPV then lends to NBFCs and MFIs. Or you can do it directly from the RBI, where the RBI provides a direct lending facility, where you can pledge your collateral and borrow money. Now there is a slight challenge, which is that the RBI will have to expand the collateral that it accepts.
Correct.
Right. So today the RBI accepts only very high quality collateral in exchange for lending. However, that has not worked. If you look at what is being done in the US, what is being done in Europe, and what was done in Europe in the global financial crisis, they expanded their collateral set dramatically.
Mm-hmm.
Okay, to the point that they were accepting unsecured corporate bonds, they were accepting, pretty much anything in order to provide liquidity. So the RBI will have to do the same thing, I imagine, to break this logjam, which is expand the collateral set and provide a direct lending facility. Now, that's only a small piece of this. Remember that in the global financial crisis, it was a banking system crisis, which had then emanated out from there into the broader economy.
Mm-hmm.
Okay. Today, you have a complete stop of the economy.
Correct.
Complete stop of the economy means that India is going to, let's say India is a $2.5 trillion economy. India is going to be completely shut for 3 months.
Correct.
Right? If you're completely shut for 3 months in a $2.5 trillion economy, that's a $600 billion hit.
Correct.
Right? Which means that you are really talking of having to provide financial support of some meaningful fraction of that amount.
Correct.
Right? If it's not the entire 600 billion, maybe it's 300 billion, maybe it's 250 billion, right? But it's not 20 billion or 30 billion.
Correct.
Right? So today, I think the problem is that the government has not come out with the kind of reassurance that the other governments have, whether it's the European governments or the US or China or Korea or Japan. The Indian government hasn't come out with that kind of reassuring statement saying that we will plug that hole. Right? Instead, what they have done is they have pushed the onus out into the private sector.
Correct.
By saying that you can't fire people, you can't lower wages. That's not going to work because companies either they make money or they die or they close, right? So the only way to solve this is for the government to pay the companies to pay the employees, right? If you look at the support programs in the US, for instance, the small business, the employment program that the US has, right? That is basically a loan to the companies, which is forgiven if they continue making payroll for the next 3 months,
mm-hmm.
right? We need something like that. Now, I don't know how easy it is to implement something like that in India, but essentially we need to pay companies to keep people employed. If we don't do that, then the hit to the economy is going to be much worse.
Correct. Correct.
And in the absence of a quick announcement from the government, or at least a statement of confidence that they will take care of this problem, the level of uncertainty rises even more, right? Already there is a high level of uncertainty, which is basically from what is the path of this pandemic, right? When we'll be able to reopen purely from the health side.
Correct.
But if on top of that, you're going to add in the uncertainty of, is there going to be financial support for the economy? Is there going to be financial support for small businesses? Then I think you're going to see large scale small business failure.
Correct.
Now, given that backdrop, it means that on the credit side, a lender has very little confidence that somebody coming in to borrow money, whether it's a small business or an individual, whether they're even going to be around in 3 months, right? If you're a small business and you're coming to a bank for a loan, the bank has no ability to forecast at this point whether you're going to survive the next 3 to 6 months.
I agree.
If you're coming to a lender for a personal loan as an individual, by and large, unless you're government employed, right, the lender has no idea whether you will have a job in 6 months.
No, I agree. In fact, just imagine somebody has a shop with a lot of clothes and everything inside, and the stock is of no value because when it reopens, I don't know what price point they will be able to sell if they will be able to sell itself, right? So what will you do? I mean, so maybe coming from employees' perspective, you spoke about employees. what should they do in this scenario? Because it's very tough for everyone psychologically. And obviously commercially also, maybe some of them are already laid off or maybe expecting to get laid off or at least salary reduction. So what should they do to sort of survive this scenario? Not the easiest one, right?
I mean, that's a very difficult. See, survival through this is really not something that I think the individual can. I mean, other than deal with their mental health and make sure that they, that they go through it healthy and they go through it sane. There is very little that an individual can do to make sure that they stay employed and so on.
Okay. Anything which they can do on skilling side so that they are ready for the different economy? You spoke about everybody is going to get turned into a digital business, right? So
yeah. So on the skilling side, I think there's a lot that they could do. It's hard for me to say specifically what they should be doing, but for instance, at DMI, what we are doing is we are strongly encouraging all our employees while they are sitting in lockdown at home to go to Coursera.com or edX or any of the online education portals. Mm-hmm. There are very high quality classes available from the best universities in the world.
Correct.
Pick a topic that you like, pick something that interests you, pick something that you think might be interesting. If you are, if you're a programmer, take some advanced programming lessons that you haven't, learn another language that you don't know much about. If you're a data scientist in the world of fintech, that's obviously something which is in high demand. If you're a data scientist, take some advanced data science courses, right? Learn from the best people. This is the time you're going to have. So we are strongly encouraging our people to do that. If there are any costs involved, we'll be happy to defray at least some part of it. And I imagine, many people are doing the same thing, in addition to becoming better cooks and being better at keeping their homes clean.
I agree. So incidentally, we used to do this, our open banking and fintech masterclasses physically. So we turned that into a digital business. And from this month, we had done 3, which is all around these segments. In fact, we are doing one more on digital lending, advanced certification next, I think 9th or 10th, which is what we are doing. So we are realizing that ecosystem is now getting stronger and stronger. People are actually coming online and spending time on Zoom and learning, right? So it's a great experience right now.
Yeah, it really is. It's a great experience. It's also a great opportunity because, hopefully this is a once in a generation thing, right? That this 3-month experience that we are all going to go through, we are not going to repeat again.
Agreed.
Hopefully, right? So we should try to make the best of it.
All right. Perfect. Thanks. Before we close, any insights to any founder who's right now looking for funds? Any positive thoughts you have for a lot of guys who are caught unaware at this stage?
I think, my fear is that given the high level of uncertainty, funds are going to be difficult to come by in the near term. Because if you're a VC fund and you can't project, if you can't project demand, if you can't project cash flows, then how do you value a company?
Correct.
Right. So until the economy reopens and until people can start getting a baseline of how bad it is, it's going to be difficult. If you look at the numbers coming out of China, for instance, even the India numbers, right, things are pretty bad. So even something like power generation in India is down 25%.
Correct.
Right. Now, power generation being down 25% is a very big deal. I don't precisely know how that translates into what aggregate demand is supposed to look like. But if you look at China, which is at the leading edge of the COVID-19 experience, they have not really bounced back. Okay. Yeah, people are talking about headline numbers of how China has recovered dramatically, but really the demand has not come back and is not going to come back for a while. So if you can't project, I suspect it's going to be hard raising money unless you're willing to cut valuations dramatically. And most founders are really reluctant to bite that bullet, right? Most founders are really reluctant to say, you know what, I recognize that things are very uncertain, and I think that in this environment, it would be, the prudent thing to do is probably to cut valuations and raise capital anyway, right? So what I was saying is that my number one advice to founders who don't have, I don't know, pick a number, who don't have a 24-month runway, right? My number one advice would be, don't worry too much about valuations, right? If you find somebody who's willing to give you money today at what you think is a relatively cheap valuation, take enough to give you room to survive. Correct. Because if you don't survive, then having 80% of zero is worthless, right? So you might as well have a smaller percentage of a number that's meaningful. So take the money if it's available would be my number one advice. In the absence of that, or in addition to that, right, focus on expenses. I know unit economics is not something you can really talk about today because the revenue projections are very, very, very uncertain. But there has been a tendency, certainly in the Indian startup system, to not worry about the expense side. And I think that luxury is over. So focus on expenses.
Correct. I think suddenly the focus moved from revenue side to pure cost side. I think whichever lever you can apply now, I think you have to apply. So thanks. Yeah. You had
exactly. Whatever you can do to make sure that you survive for the next 24 months.
No, I agree. In fact, when the first week of when the COVID hit us, we were also hit very hard. And I know now that we are back to a bit of a normal one, next month should be as good as the March number. But I can tell you that you have to go through this grind, and we are very happy that we have been able to cut some cost without cutting the salaries. And hopefully, as things grow back, I think we'll move our business more and more digital. So thanks Shiv for those insights. I think I've not heard that much of depth of information across board. I think from a government policies to founders' view to customer expectations. So phenomenal stuff. I've learned a lot.
Thank you. My pleasure, Samir.
Thank you. Thank you.